Good morning, Doctor and fellow classmates. Today I will answer the final assessment of ADW 723 Seminar in Financial Decision Making for the topic of cryptocurrency, Bitcoin mining and environmental concerns. In particular, I will be answering essay number 2, Corporate Governance, Code of Corporate Governance and Issues, by explaining my poster entitled Reform in the Digital Asset Era, Bridging the Governance and Sustainability Through Structural Code. So the main message is simple. Many problems in the crypto industry are not only caused by technology, they are caused by weak governance, poor control, lack of transparency, and unclear regulations. First, the poster discusses about the governance crisis using FTX as the main example. FTX failed because there was no clear separation between FTX exchange and its related trading company Alameda Research. This created a serious conflict of interest because the same group had too much control over customer money, trading decisions, and company operations. The poster describes this as a US 10 billion agency failure. In simple terms, this means that the manager were trusted to protect customers and investors, but they acted more in their own interests. This links to agency theory. Agency theory simply means that managers are responsible for handling other people's money. But if there are no strong checks, they may misuse that trust. The poster also mentions about the hubris hypothesis. When leaders become too confident and nobody challenges them, they may make risky decisions, overpay for business targets, or expand too aggressively. So the lesson from the FTX is clear. When power is too concentrated and there is no proper supervision, failure can happen very quickly. Second, the poster discusses about the crypto mining and environmental costs. Crypto mining uses a lot of electricity and creates electronic waste. The poster shows that two important figures, 173.42 terawatt hours of energy used annually and 30.7 kilotons of e-waste produced annually. The concern is that these environmental costs are often hidden. Some companies may claim they are using clean energy, but the energy source may not be fully controlled or verified. This can lead to greenwashing, which means a company looks more environmentally friendly than it really is. So the key point is that crypto mining companies should not only claim they are sustainable, they must prove it with clear and verified data. Third, the poster explains the regulatory battlefield. So for different places have different rules. Some places are strict while others are more friendly for crypto mining. Because of this, companies may move to locations with easier rules. This is called regulatory arbitrage. In simple terms, companies may shop around for the easiest regulations. The poster also shows the conflict between the government and data collections like EIA and DOE, initiatives and industry resistance. The problem is that if companies can avoid reporting by moving location, transparency becomes weak. To solve this issue, the poster proposed a four pillars governance code. Pillar number one is a structural integrity. As you can see from here, that crypto exchanges, custodian, and trading firms must be legally separated to avoid conflict of interest. Pillar number two is the senior managers regime. Important areas like IT, liquidity, ESG, security must be assigned to responsible senior managers. If something goes wrong, there is a clear person accountable. Pillar number three is a verified transparency. Company must disclose real and check information such as hardware hash rate, Scope 1, 2, and 3 emissions. This helps the investor know which companies are truly less responsible. Pillar number four is the integrated capital allocation or strict financing. This means that companies with better governance and cleaner operations should get a better financing terms. Companies with poor governance should face higher financing costs. At the bottom of the poster, each problem is matched with a solution. So overpaying for targets is solved by independent review. Asset misuse is solved by structural separations. Greenwashing is solved by mandatory disclosure. Managerial inefficiency is solved by financing discipline. So to conclude, that this poster argues that the crypto industry needs a stronger governance because its risks are fast, complex, hidden, and mobile. Crypto innovation should not be an excuse for weak governance because crypto is risky, fast-moving, and it needs stronger rules, clearer accountability, and verified transparency. If these four pillars is applied, it can reduce conflict of interest, prevent greenwashing, improve investor confidence, and support long-term financial sustainability. Thank you.